We're not in a global financial panic right now. We may be heading for one. We talked about that separately. We're not in one right now. We are in a recession. It looks the U.S. is definitely in a recession right now. We had 2 consecutive quarters of decline in GDP, first quarter, second quarter. Well, that's a recession. We'll see what third quarter is going to be, but it may be prolonged. It may get worse. Europe is in a recession based on the latest data. Japan is in a recession. China looks like they're in a recession. They reported their most recent growth figures of 0.4% for the second quarter, not 4%, but 0.4% versus compound growth of over 10% for about 30 years. And they lie. So if they're admitting 0.4, I have to believe that's negative. So we're really looking at a global recession. Now, a recession or even a depression, which it may turn into, is not the same as a financial panic. You can have panics without recessions. We saw that in 1998, 1987. You can have recessions without panics. We saw that in 1990 and 2020. Sometimes they do go together. 2008 was an example of both, a severe recession and a severe financial panic. But I would keep those separate because if we're not in a global financial panic, then we don't necessarily have dollar buying because of get me out of everything else. The dollar generally does rally in a financial panic. That's correct. And it does so because people want the best assets they can find. They're like, the best description I've ever heard of a financial panic is everybody wants his money back. Doesn't matter what you're in, get me out, sell it, whatever. I want dollars. Well, when you get the dollars, you got to go buy something. So you can leave it in the bank, but banks are risky. The problem in 2008 is the banks were failing, and that didn't quite happen in 2020, but it absolutely happened in 2008. So they buy treasury bills. They buy treasury notes. They're the safest assets. They may not want them for long, but you can buy a 2-year treasury note or a 6-month treasury bill. You're not in it that long and your money's safe. So there is a demand for dollars somewhere around the world to buy that really good collateral because it looks like a safe haven relative to everything else that's falling apart. That's not exactly what's going on today, but it's related. But we are in a recession. Now, the recession should damp down the inflation. It hasn't yet. Inflation's high. There's no question about it. We see it in the data. You see it at the gas pump. You see it at the store. But that may trend a lot lower very quickly, but not for good reasons. In other words, you say, well, what's the Fed doing about inflation? Well, they really can't do anything about it. The inflation is coming from the supply side. Inflation can come from probably a lot of places, but 2 places in particular, supply side and the demand side. Supply side inflation is when there are shortages, there are bottlenecks, there's supply chain dysfunction, people run out of stuff, there's not enough fertilizer, not enough water, not enough truck drivers, ports are clogged, you can't get the input A to make item B, so you got to shut down assembly line because you can't get, titanium from Russia to build Boeing aircraft. But supply chains are breaking down in many different respects, and prices go up as a result. But the other kind of inflation is called cost push inflation. The other kind of inflation is demand pull inflation. This is when consumers change their behavior. They get it in their heads like, hey, prices are going up, they're getting out of control, I better go out and buy that thing, And this is what we lived through in the 1970s, and I remember very well. If you were going to buy a refrigerator, a new car, a dishwasher, whatever, you'd say to yourself, I better go buy it today, because if I wait 3 months, it's going to be higher, or 6 months, it's going to be a lot higher. So, of course, that just pulls demand forward and it creates excess demand relative to supply, and then prices do go up, and it feeds on itself. Next thing you know, bosses are handing out raises because of inflation, people just spend more, etc. The Fed can do something about demand pull inflation. They can destroy demand by raising interest rates, raising mortgage rates, credit card rates, and everything else. They can't do anything about supply inflation, the supply chain inflation, cost push inflation. They can't do anything about it. The Fed doesn't drill for oil. The Fed doesn't drive a truck. The Fed doesn't run a cargo line. The Fed doesn't mine, titanium in Russia. They can't do anything about any of those things. Inflation means prices are going up. But if they're going up for that reason, 2 things are true. 1, the Fed can't do anything about it. 2, it will probably run its own course in the sense that, if prices go higher, there's going to be a lot less discretionary income. You still got to put gas in your car and you still got to put food on the table. If those 2 things have doubled in price, and they have, then you have that much less left over for everything else. You'll say, well, I'm going to skip the vacation, skip the concert, skip the restaurant, a lot of things, new furniture. I'm not going to buy any of those things because all my money is going to buy gas and food. So you still get the gas and food, but not more. You just pay more, and the value of your dollar goes down, real wages go down, and you're not spending money on anything else. That'll put the economy in a recession real fast. That's happening. I mean, we're in a recession. I already said that, but it will get worse. Now, here comes the Fed, right? always a day late and a dollar short, or maybe too many dollars, but they always get it wrong, is my point. So what are they doing? Well, they're saying inflation in the numbers. They don't really seem to distinguish between supply side and demand side. And they're going to the Volcker playbook. Raise rates, raise them, raise them, raise them, raise them, raise them. That can get inflation under control, but only at the cost of a much worse recession, higher unemployment, business failures, people out of work. I say, who cares what the price of gas is if you're sitting home unemployed? The Bretton Woods institutions are still around. The World Bank kind of does what it was always supposed to do. The World Trade Organization is bigger and more powerful, but it does what it was supposed to do. The one that's changed the most is the International Monetary Fund, because we don't need swing loans for deficit problems anymore. You just devalue your currency. But they do make loans. Usually they're highly political, highly selective, and they do kind of work around the edges of global financial crises, but that really falls back on the Fed and the other central banks. So we're still in an age of Bretton Woods, but we're not in an age of gold. Bretton Woods pegged all currencies to the US dollar. And then the US dollar was pegged to gold at $35 an ounce. Now, by extension or, transitive law, if you want to use some sixth grade math, you were kind of pegged to gold because you were pegged to the dollar and the dollar was pegged to gold. But technically, you were pegged to the dollar. That made the dollar the kind of global hegemonic currency, if you will, but also left the UK extremely vulnerable because they had issued a lot of sterling, pound sterling notes denominated in sterling to the Commonwealth countries, Australia, Canada, India at the time was still part of the British Empire, etc. They were technically redeemable into gold, but there's no way that the UK had that much gold. It wasn't even close. But by diminishing the role of sterling and elevating the role of the dollar, highlighting sterling's vulnerability to a run on gold, exacerbated economic tensions with everybody, including Canada, Australia, and a lot of the African members of the Commonwealth. But coming out of it, you did have a world where the only currency pegged to gold was the dollar and everybody else was pegged to the dollar. Now, why did they do it that way? The answer was that they felt that other currencies might run into difficulties, trade deficits, imbalance of payments, etc., and might have to devalue. Now, they didn't want anyone to devalue. That wasn't necessarily the plan, but realistically, they thought it might happen. Again, that was one of the problems of the 1920s, 1930s, is that devaluing against gold was a total crack up. It usually came hand in glove with a banking panic, as it did in the UK in 1931. So they felt that if you could modulate that process, the dollar was always pegged to gold. That was the anchor of the whole system. But if you ran into trade deficit problems, there was a swing lender. The swing lender was the International Monetary Fund. That was really the role of the International Monetary Fund at the beginning. Throughout the 80s, 90s, and into the 2000s, it's become this global monetary policeman. They impose all kinds of deals. They make loans. They made multi-billion-dollar loans to Ukraine a couple of years ago. Ukraine did not meet any of the criteria for a borrower, but obviously it was political. So the IMF has become like the finance arm of the U.S. State Department, and a highly, highly political organization, wandered very far from its original intention.